John Garrett, thanks very much for joining us today, mate.
Well, thanks for having me, Greg. Appreciate it.
No worries. So, for people who are watching this, I stumbled across John through his Masters Invest website, which I've made available in the email that's gone out to members for this video. Also, want to point out you've been with MA Financial for 15 years. So you've obviously got a deep background in financial services. But for anyone looking at the Masters Invest website, shows that you've also got a deep knowledge and a deep appreciation for the masters of the investment world. So I maybe wanted to start off by asking, where did this obsession come from?
Well, Greg, I think over the years, and as you say, I've been involved in the markets for about 30 years. I always kind of look at investing as it's a journey. It's about learning. You can never know everything, and when you're learning anything, I think to look at the people that are successful and how they've achieved that success can be very useful, in terms of investing. So, when you go to uni, normally you study a lot of formulas and, the mathematics, I suppose, behind investing. But if you were to, like, for example, if you were to start undertaking to learn how to play golf or some sport, you're probably going to learn, look at people like, in golf it would be Tiger Woods, or, in other sports it would be other people. And so I think for myself, it was, in terms of the studies, it really missed that in terms of, studying what great investors, how they've achieved their success. So I kind of probably starting 25 years ago, I started to go down that rabbit hole and, kind of studying great investors and trying to ascertain what are the common characteristics that have made them successful.
It's a good point, because if you look at most people who are successful in business, they've all had mentors as they've been as their careers have started, and they've gone under the wing of someone that they've learned from. And I think we forget as investors that there's a huge repository of knowledge out there that we can tap into as well. So who, out of all those people, and look, I suggest anyone go onto the site and look around. There is a huge amount of information there, and it's probably going to take you a good couple of years to get through it all. You've obviously spent a lot of time building it. What was the motivation for putting all that information together?
Well, I used to, when I was back at UBS, I used to write a daily note, and on that daily note, I used to have a quote at the top of it, and I'd keep this Word document with all these quotes of things I've read about great investors, so interviews, letters, maybe books that they've written. And then I decided that if my kids, when they were younger, this would have been 10 odd years ago, when they were younger, wanted to study investors, that maybe I should put down that information in a format that might be useful for people that were starting investing. So really, that's how it kind of started, was trying to find the information and the common threads from great investors. Like, here's a place where you can go and find all of those. So, and it's got to the point now where it's really, it's a resource that I use, multiple times a day in terms of my job, in terms of going back and, kind of rereading about, different situations and different companies and so forth. So that was really where the whole idea kind of started.
And it's also developed quite a global following too. We were having a chat beforehand, and you mentioned that none other than Howard Marks has taken a bit of information from your blog, which led you to having a chance meeting with him. Do you want to give us the background on that one?
Yeah, that was I was really chuffed. Probably 3 or 4 years ago, I wrote a piece which was it was titled "Fight the Fade," and it was about great companies and how great companies can fight the fade, in terms of, maybe we'll talk about a little bit about that, but how they can continue to grow at high rates of return, and buying these businesses and holding them for the long term, is really it's the strategy. It's the strategy that obviously Warren Buffett and Charlie Munger developed Berkshire with. And Howard had picked up on a piece that I'd written and kind of questioned. He's very much a buy low, sell high kind of guy. And being in private credit, that's really the type of investing that you're trying to do. You've got finite life for your funds, notwithstanding that's certainly changing. So he actually referenced, he wrote a piece in this blog, in one of his memos, saying that maybe this had changed the way that he'd thought about investing. So I reached out to him, and as a mentor, I suppose, or someone that I would look up to, a role model, maybe. Told him I was chuffed that he'd read it, and he said if ever I was coming through New York to drop in, and so that was in the middle of COVID. So probably 3 or 4 years later, I was in New York when I took my kids to New York, and then Omaha for a bit of a business trip, and we managed to catch up with Howard and meet him in New York. So that was certainly one of the highlights of the trip.
And he was very generous with his time, you mentioned.
Yeah, I couldn't believe it, actually. I expected I had met him a couple of times in Australia. I expected to pop in and hopefully get an autograph and a photo. And he sat down with my 3 children that are kind of in their 20s, and really gave them a 101. Each of them are studying commerce at university, and I said to them, look, this is this is the best lecture that you guys are ever going to experience. So it's. He's a really humble guy. He's very open-minded, and so it was a real highlight of the trip.
And you've been to Omaha a few times for the Berkshire meetings. What are they like?
The Berkshire meetings are fantastic. I was fortunate enough to go. I think the first one I went to was in 2018, and then I went again in 2019, and I think 2020 it was cancelled because of COVID. And then I managed to get back there this year. It's really an opportunity to kind of, first of all, to experience someone who is like a big role model, for me. They basically, Warren sits down there, and previously with Charlie, and answers questions for 5 or 6 hours. Any question that gets asked to him. I remember I was in the line, and we made sure we got there early to get some good seats. And there was some couple of guys there, and I asked them in the line what they were, were they in business, and they were in the businesses themselves. And they said, this is the best 6-hour MBA that you'll ever get. So, it's easy to get the tickets. You can buy them on eBay. Probably only cost about $25 US. And then you get, the other thing is there's all these people that have, a real interest and excitement about investing. And, so normally when we go, there's some guys from Australia. We normally go to Warren Buffett's favourite restaurant there in Omaha.
The Gorat's, the steakhouse.
Yeah, that's which is it's great, and you meet lots of great people that are really excited about learning and excited about investing. So if anyone gets the chance, I'd highly recommend it.
Absolutely. You mentioned fight the fade before, and I want to go back to that because I think there's a lot that we can talk about in relation to that comment. But I just want to stay with the investment masters for a little while, just because I think there's so much that we can dig into there. On your website, there's a good couple of dozen of brilliant long-term investors who have got amazing career track records. It's probably a big ask to say who are your favorites. Maybe who are your favorites? Maybe who do you identify with? And I ask that because investing is a very personal thing. You've got to find, I guess, someone's personality that suits your own style of investing. So there can be greats across the board, but then you look at a Stanley Druckenmiller, he's more of a trader type of guy versus a longer term investor like a Buffett or a Chuck Akre or something like that. Who are your top couple that you would identify with most closely, do you think?
Well, I think, it's a kind of a journey, investing. And, I probably started off more, reading about the Druckenmillers and Soros and Paul Tudor Jones. And then, over time you find these fascinating investors like, in quant, there's Ed Thorpe or, Jim Simons. And I think there's something that you can learn from each of those investors about, maybe it's not your style of investing, but you can certainly, learn a lot about different styles of investing and so forth. And I think for me, it's really, I've got to that point where it's really about buying these quality businesses. So certainly Buffett and Charlie Munger, as you mentioned, Chuck Akre's very good, Peter Keefe, the guys from Lindsay Train, Marathon, a guy that's kind of been under the radar and doesn't run a fund anymore, a guy called Nick Sleep from Nomad. I found, his letters that were, they were almost impossible to get 5 or 6 years ago, became released. And when you kind of dig into how he thinks about investing and the mental models he uses, he's probably one of the most underrated, or I wouldn't say underrated, but certainly unknown investors. It was a real eye opener to read, how he thought about investing and thought about businesses. So, but probably the guys that are really trying to find the quality businesses and stick with those businesses over the long term is, I think that's what Joe Average can do as an investor. It's very hard to look at a Stanley Druckenmiller and say, look, I'm going to replicate. As I say to people, there is only one Stanley Druckenmiller.
Yep.
George Soros, for example, Ray Dalio, great investors in their own right, Jim Simons, but the average person on the street's never going to be able to, kind of replicate. They can learn from them, but they can't replicate, in my mind, what those guys. I mean, Jim Simons, if you want to get a job there, you have to have a Renaissance Technologies, and Jim's passed away. But if you want a job there and you've studied finance, you have no hope. You have to be a PhD or he was a cryptographer. So,
yep.
I think for the average person, and I think it's an easier way of investing.
What do you think? I guess the other aspect to the great investors is their temperament. How important is that, or how consistent is a temperamental aspect or emotional intelligence across the great investors, do you think?
I think it's critical. Absolutely. I think it's probably the defining factor of these great investors is their ability to exercise patience, to be open-minded, not to be fearful. It is a really, really challenging. That is the really challenging part, I think, for investing. And Warren says that if temperament's 90, I think he says it's 90% of the job. And as I think when we caught up, we spoke about the natural inclination for people is to be fearful. We feel fear at 3 times what we do feel kind of positive or gain. So that ability to kind of have resilience, to have a balance of humility and self-confidence, I think are critical. And it's a very hard thing for you to overcome, because it's like if you're scared of snakes or you're scared of heights and someone says, well, don't be scared of them, like here are all the reasons. It's a bit like when the market crashes 20% and people say, look, don't worry about it. It's a natural inclination for humans to feel fear. So we haven't evolved really to be good investors. So I think that is one of the traits that generally defines one of the key traits that defines the great investors for sure.
And do you think that comes naturally to them, or do you think it's like a skill like any other, where you've got to work on that mental muscle to constantly remind yourself or constantly resist the evolutionary impulses to panic and run and to try to maintain rationality at all times? How hard do you think that is?
I think it's interesting, because I think, having spoken to a lot of investors, it would seem that some of them are genetically that way inclined. So Peter Keefe, who I spoke to recently, Francois Rochon, who I chatted with a few years ago. If you read about Warren, I think they came to investing with that. They already kind of had that kind of independent mindset. I don't think it's natural though for most people. Do I think it can be learnt? I think there's things that you can do as an investor to help you kind of to get to that point. But I think it's. I would say my general view would be it's a balance. Some people have that, kind of inbuilt, and the other great investors. Probably get there. I mean, Stanley Druckenmiller has said that, like, when things are down, like he feels physically ill. So, and yet he's probably the greatest trader, in the last 50 or 100 years. So I think it's a mix, but it's something as an investor, if you can get on top of the emotions and, it gives you a big edge.
What about personally? How do you go about managing that side of things? I mean, you're managing a fund day to day, so obviously it's of importance to your job. Are there any sort of things that you do as a training routine, or is it just something that over years and having got that experience that you're sort of more attuned to?
Well, I think it's having an understand. It's first of all, it's understanding, in the type of investing that we do. So it's understanding what we own, why we own it, and kind of having because I've been in the markets and very close to the markets for 20 or 30 years, I've seen some crazy stuff happen with pricing. We saw it in COVID. I was working on the hedge fund desk at UBS through the GFC, so we saw some unbelievable type of behaviour. For me, I think it's understanding. Look, what are the businesses that we own? Are they good businesses? It's and that delves into other things like, if the business disappeared tomorrow, would anyone care? It's all the factors, the characteristics about those businesses. And then hopefully it's having some understanding about why maybe the stock prices are doing, what they're doing. Like, why is everyone selling the stock? Are they likely to be wrong? But make no mistake, it's I certainly I certainly don't feel good when you own a stock and it falls 10 or 20% in a matter of days because of some piece of information that's come out. But I try to remind myself that stock prices can do crazy things. When we go into an investment, I'm of the mind. Look, I think this is my thesis. This is my thesis, but I think I'm right, but I could always be wrong. So I'm always looking for more information. And if a stock price moves against us rapidly, or there's a piece of information out, then we'll go back and reassess. Like, what is it? Have we got something wrong? But yeah, it's really having an understanding, I think, of what you own, and most investors use price as news. So when the price falls 10%, most people sit there and they're like, okay, well, there must be something wrong here. They don't really understand the business. Keep in mind that most investors, they don't do a lot of people that own stocks haven't done the research, and at the margin, it's the marginal sellers. So they can push stocks, aggressively down, and then algorithms can get involved. So it's having that kind of, that understanding about what you think about that business. And, if you look back over time, the great businesses have had massive drawdowns, and yet they've been the times, and the same for the market. That's been the time when you want to buy. But, I think just having a broader understanding about markets and understanding the things that you own, and not taking price as news. So, prices can do crazy things. Expect that. Just because the stock's fallen 10 or 15%, think they just do it. It's kind of, welcome to the circus.
I think that's one of the key learnings that I've got from reading a lot of those masters on your site, is that all of them have the view that there is a difference between price and value, and they understand that prices can move around based on the whims of investor emotion and sentiment. And emotion in the short term is probably one of the things that drives that price around. And bad news might impact intrinsic value, but emotion will push a price well below that in the short term. And I think that those great investors understand that if they can take advantage of those emotional swings, that's where they can get the upside. Just on that, the other characteristic I picked up is the sort of is the view that most of these investors have a contrarian streak in them. So they're sort of wired to go against the crowd, and whether that's an intrinsic wiring in themselves, or whether that's something learned, I'm not too sure. But how much stock would you put in that view that most of these good investors understand that to beat the market, you've got to do something different from the market, and you've got to be prepared to be independent of mind and to go against the crowd at important times?
I think that's a critical trait that that the great investors have, is they tend to be independent in terms of their thought processes, independently minded. They've done the research. They're not scared by price. They see volatility as their friend, as an opportunity. These guys are investors. They're not traders, so they're not running stop loss orders. They're looking through to the intrinsic value of the business, and they've probably got some idiosyncratic view, or some different view from the market, and that's where you get you can get a real edge. So I think they've got a contrarian streak, but by no stretch are they contrarian for the sake of being contrarian. So the great investors, just because everyone hates something doesn't mean that you should go and buy it. Might mean you're more inclined to have have a closer look at a sector. But I think, the type of investors that we look at are not, their hunting ground is not really let's go and find stuff that's beaten up and hated.
Not the
I mean, that's
cigar butt.
yeah, that's certainly a style of investors that are very successful. But the guys that are long-term hold are really trying to find, sure, like that's a style of investing that can be very profitable. But if you're going to be contrarian, you got to make sure you're going to be right. And so I would say that they don't just go looking for busted like the dogs of the Dow. Let's buy them this year, and that's not their strategy. But
Yep.
yeah, I think when it calls to be contrarian, absolutely they have the capacity to be that.
Well, that's probably more so in the times where you get deep market sell-offs, where there's panic and fear in the market, and some of these quality companies, and in Charlie Munger's terminology, the wonderful company at a fair price. Those fair prices can get very fair and can get quite attractive, and I guess that's when the great investors will move in and take advantage of that. So maybe we could talk about that style of investing, the buying the wonderful company at a fair price. Most of those companies that you look at exist in offshore markets. How difficult do you think it is for not Australian domiciled investors, but Aussies looking for Australian style stocks in that manner? Are there many on our exchange? I mean, it strikes me that we're a very cyclical market. We've got banks and resources, and not a lot of areas where you might have in the States or even in Europe, for example.
Well, I do think it's a challenge for the average Aussie investor. It certainly hasn't hurt the Aussie investors over time, though. I think the Australian stock market over the long term has been a top three performer.
Yep.
In the world. So it's up there with the US, and I think it's either Israel or South African markets probably the next best performing. But as you say, the composition of our market is it's significantly different to most global markets. 40 odd percent of the market's in financials. Resources make up probably 30% of our market. Most active funds wouldn't actually be able to replicate the Aussie market because they would have too much exposure to certain sectors. I mean, a lot of funds put a 20% limit on how much they can own in a certain sector. So IT makes up about 3% of the ASX 200. It makes up probably 35% of the S&P 500. And you look at our businesses, our biggest businesses, most of them have probably been around for 50 or 100 years. You've got BHP, Rio, CBA, ANZ, the banks. We don't have a lot. Then you look at the US, and all the great businesses that are there haven't been around. Facebook, Google, Nvidia, they haven't been around very long, these businesses. So I think there are good businesses to be found in the Australian market. It's harder to find them. They're probably more expensive here because we have the superannuation system. We have so much capital that's coming into the Aussie market. We've got quite a big home bias for Australian investors. So I think that to find these kind of compounding machines, it's much more challenging. But there are, we think there are some very high quality Australian businesses, predominantly with global business, kind of global exposure in the Australian market. But I think if you're looking, the pond is much bigger, I suppose, overseas than in Australia. And going forward, given where some of the valuations are, it might be a bit more challenging for the Australian market to deliver the type of returns it has in the past.
You mentioned valuations, and I guess that's a bit of a topic at the moment. The US market all-time highs. Aussie market just hit all-time highs yesterday. We're recording this on Thursday, the 20th of November. Warren Buffett's got $325 billion in cash, which I looked into yesterday. That now represents 30% of the asset base of Berkshire Hathaway. I think that's the sort of thing you can do when you've got permanent capital, but it's a bit more difficult when you're running portfolios that are benchmarked. What are your thoughts on old Warren building up that cash pile to such a large extent in view of the valuations in the market at the moment?
Well, I know a lot of people talk about Warren, as a bearish signal that, hey, Warren's got heaps of cash and, the market must be about to crash. I don't subscribe to that view. Warren's got a lot of cash, and it's very hard for him to deploy that capital into businesses relative to Joe Average. $325 billion. I mean, there's not many things he can buy, and he's very strict on his valuation criteria. So I
Yep.
think he probably looks at his portfolio and says, look, the type of returns I can get out of these businesses, and not what not when not where they are when I first bought those businesses. So. And I think it's challenging. He said it for years. He said that it's been challenging for him to find a big business to buy. So I don't. At the same time, he's always said he can't predict the market. He's all the bullish on America in the long term. Like, he's always said that. Like, never bet against America. He said, like, I've never met anyone that can forecast the stock market. I don't think he's suddenly changed. So I just wonder whether he's 93 or 94 years old now. Charlie's gone. Someone else, obviously in the future is going to take over managing it. I just wonder whether it's in some ways he's preparing maybe a little bit for that. But I wouldn't read into it that Warren thinks the market's going to crash tomorrow. He has said over the last 50 odd years that he thinks for the major part the US market has been in a zone of reasonableness. And I think people forget that. So he's come out, I think, 6 times and said either the market's too expensive or the market is, is very cheap. I think in 1970, I think it was in the early 1970s, he came out and said, like, that's the cheapest he'd ever seen it. And then back in 2010, he wrote a op-ed piece, I think, in the New York Times saying, or the Wall Street Journal saying, like, now is the time. So most of the time he thinks that the market's reasonable, and I think for the average investor, I do think the broader market is probably reasonable. I don't think it's certainly there's pockets of excess, but if you look at the market and you strip out the Magnificent Seven stocks, this market, this bull market we've had, most sectors have underperformed historic bull markets. Small caps have been the worst performing. It's been the worst performing small cap market relative to other bull markets for in the last 13 bull markets. Cyclicals have underperformed, defensives have underperformed. So yeah, you've got a top end of the market that maybe is excessive, but the other parts of the market I don't think are flashing red signals.
I made a similar point in the note I sent to members this week or last week, and I got onto the Masters Invest website and I went back to the Buffett partnership letters when Warren was sounding a bit of an alarm back in the late 60s. And if anyone's read about the go-go market of the late 60s, that was a crazy market. There was, prices, today's market would not hold a candle to that. So he first sounded that warning, I think, in 1967 and told his Buffett partners that he was reducing his benchmarks or the expectation that he would outperform the Dow Jones. Then I think it was maybe early 1969, he said, look, I'm winding this up. I'm going to concentrate on growing Berkshire. So he had this sense that there just wasn't the opportunities in the market. Yet there was a lot of volatility and the market itself didn't peak until 1973. So I was using that example as saying, look, Warren focuses on valuation. He's not commenting on whether the market's overvalued. It's just a comment on what he can find available based on his way of investing. So I agree, the market might be stretched, but it's very difficult to deploy $325 billion of cash readily. So he's just going to be patient and wait for his opportunities.
Yeah, I think that's right. I mean, there's obviously, a lot of headlines that Warren's, this is it, and he's trying to tell the market, that it's time to get out. But I don't think that's the case.
I think that the telling sign will be when we start seeing headlines that Warren's finally lost the plot. He doesn't understand this market. And he's just sitting on the sidelines. So I think that'll be a sell signal. But we might be a little way from there.
Yeah, well, I think that's as you probably read those letters, I think that's probably what he was saying in the when he closed down the fund in the early 60s. So the market is it's, over time it goes up. We have ups and downs, but it's a beautiful thing, and it comes down to companies' ability to compound their own capital at 10 or 12% over the long term. If you look at the earnings, it's not like the market's had a massive run, and the US earnings aren't supporting The US earnings have gone up a lot, and that supports ultimately the stock market follows earnings. And I don't think there's anything, on the horizon that's changed why companies won't be earning significantly more in 10 or 20 years' time.
I think one of the things that I think about a lot is the you just mentioned the ability of companies to compound, and that's the whole don't fight the fade, stay in those stories. And previously, going back to contrarianism, but David Drummond's book Contrarian Investment Strategies talked a lot about reversion to the mean. And since he's sort of written that book, that reversion to the mean's been a very hard investment strategy to follow. And then with the internet companies that have come out and the network effects and the winner takes all type of strategies, that has been the dominant business model of the last 10 or 15 years. And now nearly everyone understands the concept of quality compounders and everyone's looking for quality compounders. Just wondering how you think about that in terms of valuation and, say, the next cycle, or whether that's an enduring investment strategy throughout cycles.
Well, I think these businesses have changed. I think we spoke about, there was a great piece by a guy called Brian Arthur who wrote in 1990 in the Harvard Business Review about increasing returns, and it was something like in the changing nature of business. And for the first time, you've got these capital, this was back in 1990, and he basically set the roadmap for what we've seen with these technology companies, is that they're capital light, and as they get larger, they get more powerful. They have these network effects, which means they as they get bigger, the moat starts expanding, and it's very hard for other companies to compete with them. You get this winner take all type strategy, and you've never really seen that in businesses really historically. Like most businesses are capital. If you go back, think about a US Steel, which was vertically integrated. They've got to go and find lime and coal and iron ore. The first thing they start doing is finding the best deposits, and then once they've used them up, then it's not as good. You get a lot of bureaucracy, transport costs go up, so you get these diminishing returns. Or just think about realestate.com.au as a business. Who would have thought that they could, if you said you're going to have an agency and it's going to own every agency in Australia, it's just not going to happen. But realestate.com.au dominate the advertising space, and it's very hard to compete with those businesses. You've seen News Corp throw a lot of money at coming in trying to offer it for free, and you still can't beat that business. So these are very, very powerful business models. They tend not to mean revert. The issue that maybe you face is the law of large numbers. When they get to a certain size, can they continue to grow? And as you say, the market is has worked out those businesses. But the challenge, I think, for investors is the multiples that they pay. You're going to have to pay a high multiple for a better quality business. But if you can find these businesses that still have a runway of growth of 15 to 20% a year top line growth, and they can defy that fade, they tend always to be cheap, as strange as that sounds, even though you're paying a high multiple. Now, obviously, the risk is if you pay 40 or 50 times for a business and it doesn't deliver, then you get the reverse of what I like to call the Davis double play, which is earnings go up and multiple goes up. You get a collapse in the multiple and a collapse in earnings growth, and so they can be more perceived to be more dangerous, but I don't think that's really really changing. The challenge is they're not easy to find these type of businesses, and it's not always the technology stocks. It can be other type of businesses that have characteristics that defy the fade.
The other aspect that I meant to mention before when it comes to the great investors, and it's sort of partly related to this question as well. The topic you were just mentioning is concentration of positions. So most of the investors don't have largely diversified portfolios, But when you're sort of, how do you think about, and I guess in your day job, how do you think about managing that risk when you're looking for these quality compounders that you know you've got to pay up for, and that you know that if you get it right, it's going to be cheap in a couple of years' time? What do you think about, or how do you think about concentrating your portfolio in those positions, as opposed to trying to diversify a bit of that risk in case you get one or two of those wrong?
Mm.
What's the balancing act there?
Well, I think it's a very hard balancing act, and it's a real challenge for even the great investors, that you find these businesses that are, can compound your capital at high rates of return, and that's one of the key reasons that people underperform the market. I ran some numbers a while back, and it showed that if you put 4% of your fund into Amazon at the time it IPO'd, and you still owned it today, 90, and the rest of it was in the S&P 500, your position in Amazon would be over 90% of your portfolio. So, no investor is going to report to their clients and say, look, by the way, we did nothing. We've got 90% of the portfolio in Amazon now.
Except
So,
Nick Sleep.
yeah, well, except, Nick Sleep and, some of these other guys, Lee Lu and Ted
Bill
West.
Miller, actually, too. I think he's owned Amazon from the start, right?
Yeah, so it's a real challenge, and it's painful, if you own, and these stocks can be derated significantly. I mean, the drawdowns that you would have had to go through in great performing stocks could be horrific. And reporting to your investors that you let Amazon go to 40% of your portfolio and now it's down to 20, they're probably going to look at you like, well, what were you doing? But that's how, and as I say, that's why the market never sells. The index never sells. Like, it never downweights Amazon because it's too big. Obviously starts at a real tiny piece of the index, but that's one of the reasons that these great performing, a guy, Hendrik Bessenbinder, wrote a piece, a researcher that showed, I think, out of the returns for the S&P 500, all of the positive returns come from about 4% of the companies. But yes, it's challenging. But I think over time, what I've found is, I've probably increased the size of the positions that we own of the businesses that we really like. And I think
You start off small, and as you get to know the position and the management more, you add. And what would be the maximum that you would let the portfolio size get to for one position, for example?
Well, I mean, we've had some unusual mandate stuff on our portfolio, but some of our big positions might get to, 12% of the, 12% of the portfolio. We probably wouldn't start it with more than like 4 or 5, but we might let it get up to, kind of 12 or 13% of the portfolio. And I think over time, with businesses, you really, the good businesses, you really, the more time you spend with them, the more comfortable you can get, and the more likely you can, kind of accept a drawdown, because you really understand, the businesses we've owned, and, we tend to own these businesses for 4 or 5 years. Every time, you meet with management or you go on a tour, you learn something more about how they run the business, how they think about the business, because you can never know, like what we know about investments is really, it's very, very limited. So we try to have these, multiple mental models about the business, but we can never know everything. But, I think over time you see how management perform in different situations, and you can get more comfort about, kind of holding these business for the longer term. So I think, if anything, I don't think there's that many high quality businesses, particularly in the smaller end of the market. So, for us, it's, when you find one, we're trying to hold on to it and make it a position that's going to be meaningful in the portfolio. But, once it starts getting up to be a large position, we do trim it. But probably the best thing, like if you look at the guys that have made all the money over time, it's it's Jeff Bezos, it's Sam Walton, it's guys, they never sold.
Yep.
They sat there. But if you write a report to your investors, I think Nick Sleep he said, like, we haven't done anything this year. But people want to see action, and action's normally, and that can be an edge for the individual investor, because they haven't got anyone to report to. They can just find, if they can find wonderful businesses. Warren's favourite holding period, he said, was forever. And I think that's, I think that's an edge for individual investors over maybe the institutions.
Well, I'm glad you mentioned that because it's been something that I've been talking to my members about for a little while now, is that they have a big advantage over the professionals because they've effectively got permanent capital. They're not, no one's going to ring them up and say, hey, I want to redeem tomorrow and you need to sell the fund. No one's going to panic at the bottom and tell them to get out apart from themselves. But I think if they recognize the advantage of being able to manage money in that way over the long term, I think you've got a much better chance of outperforming if you're interested in the market and if you're willing to follow the stocks and be pretty hands on with it. You probably got a better chance of outperforming the market than say the professionals who are constrained by things like the institutional imperative, career
Yeah.
risk, ratings agencies that will come around and say, why is this at such a weighting? All these things that are designed to manage risk and not
Mm.
make you look stupid. Whereas if you know what you've got, it's like Buffett said, diversification isn't a smart thing to do. Just have a few eggs and watch them very closely.
Yeah. Yeah, I think that's completely completely right. Is that if you know the businesses and you can as I say, like that's where the great guys, like you look at the Forbes 400, it's people that own their own businesses that haven't sold those businesses and have stuck with them, that are they're the kind of outperformers. Market timing, like if you study the great investors, they will tell you like they can't time the market. Even guys that run more trading orientated strategies, Steve Cohen or like runs probably one of the best hedge fund guys, has said none of his guys can time the market. People think they can. The Wall Street strategists will tell you they can, but if you read the great investors, they can't make money. They can't make money timing the markets. So for the average individual to think that they're going to pick the top and bottom, it's probably it's a fool's errand.
Yep, 100%. So what are you doing at the moment? Your day job, MFF Financial. You help run a smaller cap portfolio. You're seeing opportunities in the small cap space. You just mentioned before that it's underperformed considerably. Must be a lot of opportunities in that area still.
Yeah, so I've been at it's MA Financial, which I've been here. I've run the portfolio since 2018. It's a smaller company. The big portfolio is a smaller company's portfolio. I think we've seen that the last few years have been this year's been pretty good, but the last few years have been challenging for kind of micro small cap. Really, like, our mandate is sub 500 million, so we're talking very kind of small businesses. It's been challenging, and a lot of the price action has nothing to do really with the performance of the underlying businesses. Can make you look stupid at the time, but that's a pretty good place to go fishing for opportunities. So we have seen, what I would say is, over the last 6 to 12 months, maybe the last couple of years, we've really seen a pickup in corporate activity where stocks of prices become news. Stocks have traded on low multiples, and then private equity or private businesses have come in, and they're paying, in some cases, pretty significant premiums to buy these businesses, 50 to 100% type premiums. So we think there's our preference is to find good businesses that can grow and be much larger businesses in the future. And we're looking at a whole heap of different things that idiosyncratic things about these businesses. But we do think and you tend to pay more for those businesses, but we do think there's a lot of kind of low hanging fruit in other parts of the market. We tend not to. We don't do commodities because we don't think we can underwrite commodity prices. If you just think back, the oil price went negative, back in COVID. Like, no one knows, even though, again, people think they can predict where oil and gold and copper's going. I think it's very, very challenging. And even if you get the commodity right, there might be problems with the mines or something. So we don't do commodities. We don't do biotech. Most biotechs, kind of don't work. There's probably one in, I think it's 2,000 of get through to phase 3. So it's a very challenging area. We keep away from narratives. We're trying to find real businesses with real earnings that have got products that if they disappear tomorrow, the market is going to care about them. They've been Buffett says he waits for the ball to leave the pitcher's mitt. He's not going to swing. We're not into like really early stage businesses. So we're looking for businesses that already do something, that are very good at what they do, and that we can look out 3 to 4 years and think, like, what can this business, what are the reasons this business can be earning more in 3 to 4 years' time, and what multiple do we put on that business? And at the end of the day, that's the style of investing that we're trying to achieve. We look at, and I bring back my comment before about those other things, as I talk about them as base rates. Like, the base rates in being successful in picking the next cancer drug is not high. Commodity stocks have been, over time, they've been, pretty average. You can have some really bad times with commodity stocks. So we don't really like contractors because, if you go and build your house, it never takes half the time or costs half the price. It's always, it's asymmetric. It's going to cost you more, and it's going to take you more time. So, we're thinking about the risks in the business, and we're looking for, kind of predominantly bread and butter businesses run by good people doing things that, are always going to be in demand. They're not going to be disrupted. If we can buy those on reasonable, multiples with management aligned, that's where we're looking.
And what's the Aussie entrepreneurial community like? Is there the management strength at that lower end, or is it widespread, or do you really need to focus in on the management teams running these companies?
I think you really need to focus in on the management teams that are running these companies. We tend to like to have management teams that are significant owners in the business. So they're looking out to the long term. They're not trying to please the market in terms of their growth numbers. They're not trying to turn into a bigger business to be a bigger business. Maybe they're happy to forego earnings this half because they're trying to get earnings in 3 years' time, which is that's the natural thing to do if you owned the business. So we tend to find that these founder-led businesses are a much better kind of pool of of fish to go looking for. So I think you have to be in that smaller end of town. It's critical. We see a lot of acquisitions that even if acquisitions are highly accretive, that really doesn't mean that it's a good deal. Perpetual's a classic case in point. I mean, I bet you every single acquisition they did in the last 3 to 5 years was significantly accretive, and the whole market lapped up the EPS accretion, and they were buying businesses that just didn't fit the model, which was big to get bigger, that had all the headwinds of their core business. So, I think having management with significant skin in the game, taking a long-term view, that are super passionate about what they do, care about the people they work for, care about their customers. They're the type of businesses that are in our kind of target zone.
That's the sort of thing you get comfort on as you learn, meet them more, listen to more earnings calls, read more reports, that sort of stuff. Conscious of the time you've given us, I just want to finish off with a couple of recommendations. You got a massive book library within that Masters Invest website. Also, we spoke previously. You're an avid reader. You said it's a little bit of a problem you've got. So might be a difficult question to whittle it down to a couple of favorite books, but can you give us a couple of good recommendations?
Well, I think the books that I like. I mean, I've read not all, but I've read certainly most of the books about the great investors, and then I read broadly about history and all sorts of things. I think anything like just expanding your kind of universe of knowledge is helpful to connect the dots, which to me, in a lot of investing is about connecting the dots. So, a lot of people just reading, investing books. I think, if you go back and study, Rockefeller and JP Morgan and the guy that started Bank of America and Sam Walton, I mean, those type of books, you'll see the commonalities between, how they thought about business and how they conducted their business is, it's so relevant to today. So, whether it's, the book Titan on Rockefeller, or I recently read A.P. Giannani's the book on Bank of America called, I think, Banker to America, which was exceptional. So I think business biographies are something that is really quite neglected. One of my favourite books about businesses is In Search of Excellence, which was written by Tom Peters probably 40 or 50 years ago. And it really goes through, it's a case study on what great businesses, the characteristics that defined the great businesses. So, when I'm reading and studying businesses today, I find the same type of, characteristics. I think that's a very good book. Phil Fisher's book, which again would be, probably 50
Yep.
plus years old. I think it was written in the more than 50 years, because it was written in the 1960s, called Common Stocks and Uncommon Profits. Like that guy's insights, it was all qualitative. It's all of the things. I think out of the 15 things he wrote about, 13 were qualitative. Buffett said that he learned as much from Phil Fisher as he did from Benjamin Graham, and he's probably more a Phil Fisher investor. So I think,
Yep.
Phil Fisher, In Search of Excellence. Read the Warren Buffett letters. I mean, the beauty of those is that anyone can read them. They're written to he writes them effectively to his sister. So,
Yep.
There's some great places to start.
Well, as someone in the newsletter business, I think the Berkshire Hathaway annual newsletter is the most widely read one in the world. Final recommendation, just on podcasts. I know you've got a section on podcasts on your site as well. What are your top 2 or 3 that you listen to that you could recommend to listeners or viewers?
Yeah, I kind of tend to read books more nowadays than podcasts. But things like Invest with the Best. Anyone where you've got any podcast where you've got someone who's been successful, either in investing or I can't recall the name of it, but anyone where you get good business people that are talking about like how do they run their kind of run their businesses. Nowadays you can get on the transcripts from great businesses, whether it's Costco, Watsco, Heiko, like these great compounding machines. I think there's plenty of good things, but Invest with the Best is a good one. There's some good ones on the website.
Excellent. All right, John, thanks so much for your time, and really appreciate your work that you've put into Masters Invest. It's a great resource. I've got a lot out of it, and hopefully my members will too. So I want to thank you for that, and thanks for joining us today.
My pleasure. Thanks for the chat, Greg. I really enjoyed it.
No worries. All the best.
Okay. Cheers.